Time to bring on board Vikas Khemani now, who's joining in, founder at Carnelian Asset Management. Hi there, Vikas. Good morning. Good to have you on board. It doesn't seem all that rosy when it comes to the global picture, and that in particular is perhaps what may be unnerving investors. Do you think that we have the capability to continue to, navigate our own course, stay isolated from all that's happening because recessionary fears, S&P entering a bear market territory, all that remains on top of mind when it comes to global markets?
I think, clearly, if you see the large part of the worry is coming from the global markets, global macro setup, and there's no answer to that. It will have to play out the way it is. And it is also wrong to say that one would not get at all impacted if something were to happen in the US and all. The only thing I think which gives the biggest amount of comfort is that whatever is pain elsewhere, India is not going through that. India is in one of the best growth phase. India's macros are very well placed, whether it is fiscal deficit or current account deficit, or India's interest rates is one of the lowest. If you see the interest share differential between the US 10-year and India 10-year. So, like I said, that whatever is a problem in the rest of the world, India either benefits from that or India is well placed from that. So, in that sense, India on a relative basis remains very well placed. And shorter term, there can be anything because there can be some bit of volatility as we are witnessing right now because of the chaotic global macro setup. But I'm sure as it settles down, whether it is 3 months, 2 months, 6 months, nobody knows. And India will again sort of stand out and do very well because there is no other market in the globe which can offer India's profile at this point in time, whether it is growth, macro stability, and governance and all counts, and which is from a medium term to long term perspective.
Because at an index level purely, we've fallen more than 1,000 points from the top, right? Do you believe that valuations are comfortable right now? And do you sense that there could be further correction perhaps from the lows that we tested last week?
I think the current correction has nothing to do, in my opinion, is not because of valuation. It is all because of the liquidity. We saw a decent amount of outflow happening in the markets from the foreigners, but of course, there is good money which is coming from domestics. But typically, we do not think markets are very expensive. Markets are in a fair value zone. In any markets valuation, there are or in any asset class valuation, there are three things which goes, earnings, so ROE, earnings growth, and the discounting factor. If you look at all three, ROE is one of its best ever. On absolute basis, on a relative basis to emerging markets, our growth is again on absolute as well as the relative basis well placed. And discounting factor, our interest rates are one of the lowest, in a historical context. Risk premium is coming down. So I think if you see all these things, I don't think Indian markets are at all expensive. I do believe that as the global macro environment settles down, we will see markets getting further re-rated, and we will, see uptick of valuation from here where we are in times to come.
So when we look back, Vikas, would last week have been a ripe opportunity to buy? And is that what you did?
Yes, I think we've been nibbling in and I mean, again, we don't look at, to be very frank, at a market level and decide what to buy and all. We do look at the companies we like, businesses we like, managements we like, and a fair value or price range which we like, and around that we operate. So we've been, last week was a decent correction. Many of interesting opportunities were there. So we do act on that. And having said that, I'm not saying markets cannot fall further in a shorter term. Nobody can predict. 4 or 5% correction can be around the corner any point in time, whether you are at 19,000 Nifty or 18,000 Nifty or 20,000 Nifty. So that risk one always carries. But I'm quite confident that when you buy in uncertain times, when you buy in times when there is a chaos, as long as you are convinced about the long-term opportunity space and long-term setup of the market, they are always an opportunity rather than the risk.
Because when it comes to banks as a theme, and I know you've got a couple of private banks in there in your portfolio, but you've liked PSU banks as well, and you've gone on record saying that you do see them report about a 20% kind of ROE in the next 1 to 2 years. But tactically, would you say that perhaps private banks are better placed right now because of the valuation comfort?
Clearly, I think we have all along been very bullish on private sector bank. We continue to remain bullish. We recently, or about some time ago, we also believe that public sector banks offer a great opportunity given the fact that the ROE profile could be similar. Historically, public sector banks had three problems: asset quality, governance, and technology. And on all three counts, they were ceding market share to private sector bank. And if you see, all three have been systematically addressed in last couple of years. First, it was asset quality. Then, we saw governance getting addressed. Most of the MDs are coming from a very good track record, and also with a 3 to 5 year kind of tenor. And lastly, most PSU banks have spent serious amount of money on technology upgradation, so which puts them at par with private sector. So and most PSU banks are available at below book. So we see that there's a potential re-rating across the pack, especially ones which are run by good leadership and who have invested into technology. So we think that there's a good possibility of delivering better returns in the private sector bank over in a medium term.
Vikas, there's been so much fervor within the primary markets. Lots of companies as well have recently made their debuts. And it seems that the consensus is that valuations are very stretched or out of whack in some cases. Is that a theory that you would go with when it comes to some of the currently listed new age tech businesses or even the recent and upcoming IPOs?
And whenever there's a good environment in the market, it always leads to a flurry of IPOs. It is very, very natural. We've seen a very significant amount of IPO pipeline as well as the promoter stake sales happening in the market. They are signs of course, indication that markets were getting stretched. So current correction in to that extent is welcome. And I always say that when you look at IPO per se should not be looked at any differently than investing in an already listed company. Of course, there's a small bit of pop, but if the valuations are already stretched, then why to look at that? So we are very careful when we look at companies. We like to invest only in companies which are less euphoric, but more importantly, I think which are solid management, solid businesses, and from a long-term perspective. In this kind of markets, the listing pops are generally we seek the least, and when the markets are stretched, those are also kind of very less available.
Sure. So, Vikas, where is it that you're finding value? I know we've discussed banks as a pocket, but where else would you recommend adding position on dips in the current market environment?
It's there across the board, like banks we've talked about. I think in power segment there's a new change happening in terms of growth driver. You could see significant some interesting ideas there. I mean I mean there's no one specific thing I can say, but I think there is an opportunities available across spectrum. Consumer, I think some point in time, there are interesting ideas emerging when one can look at, one should be ready to sort of explore. We have not bought any consumer stocks in last 3 4 years, but we've been kind of now evaluating very closely that can there be an interesting play out there. So you keep looking at ideas, and but to be honest, right now I can tell you we are fully invested. I mean we have small 3 4% cash. It's not a lot. So we are not as worried about valuation. We are not as worried about the potential growth which India has to offer.
All right. What about really banking on the capex theme down the line, Vikas? How are you looking at really building up on, helping an investor build up on the manufacturing theme, as well as on the boost to infrastructure, etc., and really looking to capitalize on this space?
India is seeing a huge amount of capex across infrastructure, private sector capex, industrials. I mean, manufacturing, we are seeing massive capex happening. So, and that cycle is only accelerating. In power sector, we are beginning to see in the thermal power segment, we are beginning to see new hope coming through in terms of new line of capex. So now, earlier there were small capex, size capexes. Now we are beginning to see the new wave coming about in terms of the large scale capexes, and I do believe that that cycle will lead again with a huge amount of push. So you will see that playing out. So, and typically, you play through capital goods company, credit cycle happens, and we are well placed across all which are enabling the capex cycle. So we invested into manufacturing, which is doing capex. We're investing into capital goods company, which are enabling capexes. We are investing into banking, which are also to some extent providing both working capital as well as the term loan to the segment. So it's again what you are playing is the entire India transformation story, and you got to play in through a balanced basket. At some level, all of them get in some sense interconnected.
They sure do. Vikas, always good to have you on the show. Thanks for taking the time out. Let's hope for a better market week ahead.